A 90% win rate can still blow your account. I know because I was one of those traders. I backtested it, I refined it, I got my win rate up, but I still kept ending up at zero. The problem was never my strategy. The problem was that I did not understand expected value. And without it, it does not matter how many trades you win. You will always end up back at square one. After collecting over 3,000 backtested trades, I found something that changed everything. My win rate is 19%, and I am profitable. Comment below if that number surprised you, because it absolutely surprised me when I first saw it. Here's the misconception that is quietly destroying most traders. Win rate equals profitability, and I get why it feels that way. If you win more than you lose, you should be making money, right? But let me show you exactly why that thinking is dangerous. Imagine you winning 9 trades in a row. Each trade makes you $50. That is $450 in profit. You're feeling good. You are confident. But then trade number 10 hits and you lose $1,000 in a single trade. You just went negative with a 90% win rate. This is not hypothetical. This is exactly now most retail traders blow their account. They stack small wins. They get overconfident. Then one bad trade wipes out everything because the math was never in their favor to begin with. So what actually determines whether your strategy makes money? Expected value. Think about it like this. The casino at Vegas does not care if one player wins big at the blackjack table tonight. They are not stressed. They are not changing their rules because they know that over thousands of hands, the math works in their favor every single time. This is expected value in action. And that is exactly the framework you need to bring to your trading. The formula itself is simple. Expected value equals your win rate multiplied by your average wins minus your loss rate multiplied by your average loss. But what is really telling you about this? Over a large enough sample of trades, does your strategy put money in your pocket or take it out? That is the only question that matters. Win rate tells you how often you're right. Expected value tells you whether being right actually pays you. Those are not the same thing. Here is your starting point. Think about your last 20 trades. Do you know your average winner versus your average loser? Not a guess, the actual numbers. If you do not, this is where you begin, not a new strategy, not more indicators, just those 2 numbers. Here's something that took me years to actually accept. You are not trying to predict the market. You are trying to have a statistical edge over the market. Most retail traders are secretly trying to predict. They want to know if this trade is going to win before they take it. But when it does not, they feel like they failed. They feel like they were wrong. Professional traders think completely differently. They think in distribution. Any single trade is just one outcome inside a larger system. Therefore, that system over hundreds of trades is what determines whether they make money or not. The casino does not get emotional when one gambler wins, but it also never stops playing because it knows the edge plays out over time, not over one hand, not over one night, but over thousands of repetitions. This is exactly how you need to think about your trades. When I take a loss now, my internal response is not, I was wrong. It is, that is one outcome inside a profitable system. And that shifts, that one reframe is what separates traders who quit after a losing streak from traders who keeps going. Comment below if you have ever abandoned a strategy after a few losses only to watch it work perfectly right after you stop trading it. Because that is not bad luck. That is variance. And variance is something your expected value models account for as long as you understand it. Stop measuring yourself trade by trade. Start measuring yourself in sets of 50 or 100 trades. That is the only sample size where your edge actually shows up. This is the part that destroys most traders emotionally, and honestly, it nearly destroyed me too. A positive expected value strategy can still lose 5 trades in a row. It can underperform for weeks. It can make you feel like everything you built is falling apart. But most traders quit right there, right before the edge starts to materialize. Look at my equity curve here. You can see the stretches when it goes sideways, the drawdown periods, but zoom out and the curve slopes upwards. This is what a positive EV system looks like in real life. It is not a straight line up. It is a curve that trends upward over a large enough sample size. I documented this across over 3,000 trades. There were moments where I questioned everything, but because I had the data, I had something most traders do not have. Undeniable proof that my system works. If I just let the probabilities play out. I actually broke down the exact numbers from my trading journal in previous videos, including my win rate, my average RR, and how I track emotional states before and after each trade. You can check out the video here. The action step here is straightforward. The next time you hit a losing streak, before you change anything, go back to your data. Ask yourself one question. Am I losing because my system is broken? Or am I losing because variance is doing exactly what variance does? If your sample size is too small to answer that, that is your real problem, not the strategy. Here's the brutal truth. You can have a positive expected value system. You can have a solid strategy. You can have the edge and still lose money because emotion destroys execution. Think about what happens after a losing streak. You start second guessing your entries. You skip setups that are perfectly valid because you are scared. But then you do the opposite. You revenge trade. You increase your size to try to win it back faster. You move your stop loss because you cannot accept being wrong again. Every single one of these decisions breaks your expected value model. Your EV is calculated based on consistent execution. Therefore, the moment you deviate, you're no longer trading your system. You are trading your emotions. And here's what makes this so dangerous. You might not even realize you are doing it. It feels like you're adapting, but what you are actually doing is introducing randomness into a system that was designed to be consistent. I have been there. I failed multiple funded challenges, not because my strategy stopped working, but because I stopped trusting it. I started taking trades I should not have taken. Therefore, my results stopped reflecting my system and started reflecting my emotional state. And the data does not lie. So the question is not just whether your strategy has positive expected value. The question is whether your execution is consistent enough to let that expected value play out. Start tracking how you feel before every trade you take. That one habit alone will show your pattern that you cannot unsee. Let me ask you something honest. Do you know your actual expected value right now? Not a guess, not a feeling. Do you know your win rate across at least 100 trades? Do you know your average winner in R? Do you know your average RR? Do you know your expectancy per trade? If the answer is no, sit with that for a second. What that means is you're making decisions about real money based on opinion and not data. You are guessing. And guessing with a trading account is just like gambling with extra steps. This is why I track every trade, every session, every emotional state. Because without data, you have no idea if your strategy actually has an edge or not. You just have hope. And hope is not a trading plan. The good news is this is completely fixable. You do not need thousands of trades to start. Begin tracking 3 things after every single trade. Your results in R, the session you traded in, and how you felt before you entered. These 3 data points above data I'll be sharing exactly how to build a full tracking system around this in a way that is practical, even if you are still working a full-time job. So make sure you're subscribed so you do not miss that. So here is what I want you to take away from this. Win rate is not profitability. Expected value is. Trading is a probability game, not a prediction game. Positive EV can still lose short term, and that is okay, as long as you have the data to prove your edge exists. And if your emotions are unchecked, it will destroy even the best system. The traders who make it are not the ones with the best strategy. They are the ones who understand their numbers, trust the system, and execute consistently over a large enough sample size. Most traders are out here trying to win trades. The goal is to build a system that wins over time. Those are not the same game. And the sooner you stop playing the wrong one, the sooner everything changes. If emotional trading is destroying your execution, the next thing you need to understand is why most traders are actually over-risking without even realizing it. And this is exactly what we covered in this video. Watch this next to find out more.